Thanks for having me today. Lee wanted to send his apologies once again. Like David just said, he was called into jury duty, so we hope that he's back here soon. But as far as today goes, he just wasn't able to shake that obligation. So again, thank you for having me, and hopefully you'll everyone will find this interesting.
Thank you.
I wanted to talk a little bit today on several of these calls that I've listened to, a lot of discussion over copper supply and new mine supply and new projects coming online, and obviously that's of interest to everybody. But I wanted to take a little bit of time and talk about the demand side of the copper market today, something that has been discussed a little bit less, and something that I think is really interesting and instrumental in the story of the copper thesis here over the next decade. For those of you who are not familiar with us at Gehring and Rozencwajg, we're natural resource equity investors. As we've just discussed, Lee has been investing in the natural resources space exclusively for the better part of the last 30 years. I joined him in 2007 at Chilton Investment Company and worked for him there between 2007 and 2015 before we left and started our own firm at the beginning of 2016. A lot of what we do is research driven, and we try to be quite original and sort of try to do our own work both on the supply but oftentimes on the demand side, where we've come up with some really interesting results that I think are a little bit different from how most people start to think about the space and start to model various demand factors going forward. So with that, I wanted to talk about the bright future for copper demand here over the next 10 years. There's really, when we look at all the different commodities that we study, and we look at, all the base metals, precious metals, energy, oil, natural gas, uranium, agricultural commodities. And on the demand side, there's really, I think, the most ways to win in the copper market. What I mean by that is there's enough different levers here, different sources of incremental demand over and above what I think most people have in their models, that you don't necessarily have to be right on every single one of them, just given the fact that each one, even in and of themselves, has a material impact. So global copper demand growth has averaged about 500,000 tons for the last several years. And I'm going to talk to you today about three different sources of new incremental demand on top of that, each of which could add another 500,000 tons of yearly copper demand on top of the base projection. So each of them could effectively increase by 100% copper demand growth going forward over the next several years. The first one that I'd like to talk about might sound a little bit strange given the fact that you would think sort of everyone has it in their models already, but that's the growth in Chinese copper demand going forward. And the reason I say that that's a bit counterintuitive or a bit curious is that most people that you listen to and most sell-side analysts will talk about how China is likely over-consuming copper, whether they talk about sort of highways to nowhere and ghost cities, or whether they talk about bonded Chinese warehouses full of copper that effectively is excess. The almost unanimous consensus view is that Chinese copper demand is going to slow. And I'm going to tell you today why I don't think that that's true. Here in the first slide that I'm going to show today, this has to do with oil, not with copper, but it's important in terms of understanding Chinese copper demand as well. And what this is, let's see here. There we go. This is what we like to call our S-curve charts. And what this shows on the right-hand side, this is a chart of South Korea oil demand versus real GDP per capita. And this has been the basis for a lot of the demand models that we use for many of the different commodity markets that we follow. And this is a trend that repeats itself over and over again across countries, across decades, and across commodities as well. And what you see is that at a low level of per capita GDP, the relationship between income growth and commodity demand on a yearly basis per capita is relatively linear, and then you begin to get into this accelerated period of time. So for instance, here we're looking at a period of about between $5,000 to $10,000 of real per capita GDP for Korea, where oil demand went from about 4 barrels all the way up to nearly 17 barrels per person. So you saw a greater than GDP level growth in that middle part of the S curve. And what happens is that as countries get richer, they all of a sudden develop some surplus income. They start to ultimately migrate their transportation preferences first into mopeds and then into motorcycles and cars, and they also change their climate preference in the form of adding air conditioning, and they also change then their nutritional preference, and they consume more protein, which is very energy intensive. And then as you reach a more developed country level of wealth, that begins to taper off again. And this is the model that a lot of people have started to use across the different commodity sectors. And the copper bears would point to China and use a chart like this and basically say something that was along the lines of, copper today represents 50% of world China today represents 50% of world copper demand, and yet they don't represent anywhere near 50% of world GDP. And so if you believe that GDP and commodity demand are at all related, then China must be over-consuming in their copper consumption. And as a result, that will eventually begin to slow. And we tried, like I said, this is all for oil here on this chart, but we tried to recreate this chart for copper markets as well back 5 or 6 years ago, and we had a lot of difficulty. The trends just weren't holding true, and that led us to originally some work by Paul Gate out of Bernstein that he had done in the steel markets, and we redid it for the copper markets. But the intuition here, and I'm going to change the slide in a second, is that there's something that's fundamentally different between oil consumption and copper consumption. Oil is consumed; it's literally burned and needs to be replaced on a year-over-year basis, and as a result, the term consumption is very apt. However, with copper, like with steel and other metals that get installed into an economy, they're not so much consumed as they become part of the capital stock of that economy. So they are added into the electrical infrastructure and into piping and into telephone wires and stuff like that, and they persist in an economy over time. So perhaps it doesn't make sense to think of copper consumption related to GDP, but instead to change that and look at the installed copper base per capita versus real GDP. And that's what we did here on this new slide 3. And what this shows every country over the last 100 years rebased their GDP into real terms per capita and looked at how much total installed copper is in each of those economies. And what you'll see immediately is that for such a diverse group of countries and such a diverse group of time, it's a remarkably linear trend. As a country gets richer, it installs more copper into its infrastructure and into its economy in a fairly predictable rate. And what you can see here is that where China is today, and this chart is a couple years old, so I need to update it a little bit, but where China is today is basically right down the fairway in terms of how much copper ought to be installed in an economy of that size. This is in kilograms, I think, but yeah, about 50 kilograms, about 110, 120 pounds per person, the last time we looked at it, is installed in the economy, which is exactly where it ought to be for an economy of its size in terms of real per capita GDP. So not only does this suggest to us that China has not been over-consuming copper, but it also suggests to us that as China begins to move into the next decade and begins to grow into a middle-income country, and even if that growth slows quite substantially, it could easily go from being 50% of world's copper production, or copper consumption today rather, to be over 70% of global demand by the middle of the decade, without it deviating too much from this trend line and without it sort of consuming at a rate other than what would be expected for an economy that size. So I think that flies really in the face of a lot of the bearish views that Chinese copper demand is about to hit a brick wall. We think that it's right where it ought to be. Copper, like I said, goes into all kinds of different parts of the economic infrastructure, notably into power generating stations, into power distribution substations, and into a host of other end uses. And so as quite simply, it's very difficult to grow an economy to a bigger size without bringing up that level of infrastructure alongside it. So that's just only going to add to the Chinese story here over the next coming decade. If China follows along this model, that in and of itself could add an incremental 500,000 tons of growth per year into the next decade, and could lead to a dramatic acceleration in global copper demand growth here. So instead of a massive slowing, instead of hitting a brick wall, we think that that source of demand is strong and will actually accelerate from here. Here you see the number of people on a global basis that are going through the S-curve tipping point. So that sort of meaty part in the middle there, that represents an accelerated period of commodity consumption. And you can see that over the last 40 and 50 years, largely from the 70s through the middle of last decade, the number of people going through that period in their economic development was about 500 to 700 million people. And then beginning in the middle of last decade and sort of in towards the end, you started to have a real step change here. And so obviously you had China that entered that cohort, but it wasn't only China. It was Indonesia, the Philippines, Thailand, Vietnam, all these fairly large countries that were all entering a period of intense commodity demand in their economic development all at the same time. And so we ended up in a period where we'd really never been before, with over 2 billion people that were going through the S-curve all at the same time. And this chart was originally put in our deck to show what we thought the next 10 years could be, and obviously that last leg higher was going to be the arrival of India. And what's really interesting today is that we think that that period is now. We think that the Indian inflection point is upon us, and that over the next 5 to 10 years, we're really seeing substantial indications that we're about to inflect much, much higher. And so why is that? People love to say that India is very different from China. They love to say that, the political bureaucracy will be such that you will never get the same levels of commodity demand, the same levels of projects and development that you do in India, that you did in China. And one of the things that we've come across that's been really fascinating is that in some ways that's true, and in some ways it's not. In some ways, India is following very closely to what China went through. It's just in a bit of a different way than I think most people are expecting. So if you go back and you look in 1970, India had a higher per capita GDP than China did. And if you fast forward to today, obviously China is a multiple of India's. And so I think that really reflects the differences between the two economies and the bureaucracy that made that development much slower to really get going in India. However, where things very much are the same is that if you look at the country's real per capita GDP, so instead of looking at time on the x-axis, you look at their real wealth, and you look at various development metrics on the y-axis, you're exactly the same in India today as you were in China, basically in 2003. So in terms of urbanization rates, you're exactly there today. Furthermore, the plan to cross over 50% urbanized in India over the next 10 years is now in place. That's the largest single driver of commodity intensity. In terms of automobile penetration, in terms of power demand on a per capita basis, you're exactly today where you were, where China was at the same level of real per capita GDP, and that was in 2003, right before China went on this massive commodity buying binge, and we think that India is there right now. The big driver for that is going to be the build-out of the electrical grid throughout India, and Lee and I traveled all through India last February, and when we were there, the Prime Minister was announcing that he had fulfilled a campaign promise to electrify every village in the country, and to really roll the power grid out to I think there was several hundred million people that were still sort of lacking in access to reliable electricity. And one of the things that we immediately concluded when we heard that announcement is we said something must be up there, because if that had really happened, we ought to have seen a massive spike in Indian copper, refined copper consumption, and we hadn't seen that in the data. And simply put, in order to take electrical power off the grid and step it down and distribute it into the towns and villages, you can't do that without a copper-laden substation. And so, if this was really happening, you would expect to see Indian copper demand really spike, and you hadn't seen that at the beginning of 2018. So sure enough, a couple months later, it came out that the Prime Minister had not been 100% truthful, And what he had referred to as electrifying a village consisted of taking a high tension power line near a village and connecting the one municipal building in that village to the high tension power line. So the trunk lines were all put in place, and one municipal building per village was wired up. Obviously, you only need a very, very modest electrical substation to do that, not too much copper needed there. And then they counted the entire village as electrified. Once news of that broke, it became a little bit of an embarrassment for the administration, and they very quickly launched two new promises. The first one was to electrify every home in every village by the end of 2018. And again, as the year ended, the Modi government announced that they had been successful in achieving that. And once again, we said to ourselves, we're starting to see copper begin to uptick now in India, copper demand, but it's still the order of magnitude is not what we should expect, and the total tons, it hasn't been going on for long enough to really make much sense. And so again, a sort of wrinkle in that statement came out, and that was that, yes, while every home is now connected to the grid, you have far too many homes connected to the same substation, and as a result, you have this massive rolling brownouts and blackouts through all of rural India. So basically, you connected the homes, but you haven't added enough substations. And so if you look where India is today in terms of its size, in terms of its the size of its trunk line grid, it's, I think, the fourth or fifth largest in the world, and yet it's the 38th or 40th in terms of reliable electricity transmission. And the difference there is in the substations, and the substations are where all the copper is found in an electrical system. So the final promise that the Modi government has now put forward has been to help to recapitalize the regional power distribution companies, and the promise has been made to have uninterrupted power by the middle of 2019 for every home in every village in India. So now you're starting to see copper demand in India begin to pick up. The data is a little bit lumpy month to month, but in a couple months ago, we were seeing prints of 30 and 40% year-on-year growth. I think that should begin to accelerate, and right now, India is running about 50,000 tons per month of demand. China, when it crossed 50,000 tons per month, within 6 months, it was at 100,000 tons per month. And now it's at 1 million tons per month. So we could be right at this inflection point. I think it's all going to be driven by the build out of the Indian power grid, and I think that's all happening right today. So that in and of itself, if you project that out over the next 10 years or so, could add an incremental 500,000 tons of year-on-year growth to the global copper demand market just in India alone. The last one that I'd like to talk about today before I finish is the effect of renewable electricity generation. Back about 18 months ago, we wrote an essay that tried to study how copper-intensive renewable power was, both wind and solar, compared to conventional coal and natural gas-fired electricity generation. And what we came away with was that, believe it or not, renewable power is anywhere between 30 and 40 times as copper intensive on a per kilowatt hour basis than conventional power. And the reason for that is a couple things. The first is that the load factors of renewables are very, very low. At best, you're talking about 30% low reliability load factors. And so in order to generate a reliable, continuous kilowatt hour, you need effectively to triple the amount of generating capacity, since each one will only be working at about 30% at any one time. The next thing is that just in and of themselves, the way you generate power in a renewable system is significantly more copper intensive. On the windmills, clearly you have a considerable amount of copper in every wind turbine that you put out into the wind farm. And in both wind and solar, what you end up with also is quite a bit of copper being taken up in the gathering system as you gather the electricity from several hundred photovoltaic solar units or windmills, as opposed to operating in one central turbine for either gas and coal. So that gathering system is all very, very dependent on copper in order to have sort of the intricate joint work there, and there's really no getting around that. And so what you end up with is a number that we calculated on the back of an envelope that said that if you moved to a renewable-based system, you're talking about a 30 to 40-fold increase in copper demand, and that was a pretty interesting conclusion. I think it resonated with some people. However, about a year later, Lee came up with the idea of trying to measure that empirically. And what we tried to do is we tried to look at a group of countries, all OECD countries, so all effectively in the same level of their development, all with comparable levels of GDP growth, except the only difference was that one group of them was going to have pushed for a big renewable mandate, while the other group did not, and wanted to see if you could actually see over a 5 or 6 year period how much the swing in copper demand between these two groups was. And so what you see here on the left-hand side of this chart, this is Japan, the US, Canada, UK, Finland, Korea, France, Sweden, Australia, and Belgium. And in every case, they saw a fairly substantial decrease in pounds of copper demanded per capita per year, anywhere from about 4 all the way down to 15 pounds. And this sort of makes sense. This was all looked at during a period of very high copper prices. What you were seeing was substitution where possible, and effectively pounds and tons being bid away into the emerging market, developing world for their sort of highest and best use. On the right-hand side are the 3 countries in the group that all pursued a very large renewable mandate over the same period of time: Germany, Spain, and Italy. And so you can see, in the case of Germany and Spain, despite the fact that almost every other European country saw substantial double-digit per capita decreases in copper demand per capita, Germany and Spain actually saw nearly a 5 pound per person increase over that period of time. Incidentally, that's exactly what you should expect given the rollout of renewables based on our 30 to 40-fold intensity figures that we were talking about. So this helped to lend a little bit of credence. And then you have Italy. Italy was basically flat. It was down about a pound or two. Again, compared to the other European countries that were down, upwards of 15 pounds in some cases. So the difference there is the renewable mandate. To the extent that renewable power is continuing to have substantial government and public support, we think that this is going to be another major driver of incremental copper demand. Again, this in and of itself, using the rollout assumptions of several forecasters in terms of renewable power, could in and of itself add another 200,000 to 400,000 tons of incremental demand per year. So here you have 3 major drivers going forward on top of the existing demand growth that we see. The first is a continued growth in China, and actually an acceleration. The idea there that people, instead of looking at copper consumption, ought to be looking at installed copper bases. And if you do that, then China's demand will actually accelerate further from here. The second is the coming rise of India, which we think is right at the cusp today, and we're starting to see indications that we're right. And then the third is this push towards renewable power, which is just an order of magnitude more copper intensive than conventional electricity generation. You don't have to be 100% right on any of these in order to see a substantial deficit in the copper market. In fact, even on a base case, it seems difficult to see how mine supply is going to keep up with just sort of base demand. And then you start to layer on all these different, what we like to refer to as, there's a lot of different ways to win here. And so that helps to provide a bit of a margin of safety for us, and leaves us very, very bullish on the copper fundamentals over the next decade or so. And so with that, that's really the end of my remarks. And thank you, Campbell and David, for having me today. And sorry again that Lee couldn't make it.